This is Nick Langley, Senior Portfolio Manager, here talking about the Q3 Valuation Pack. So a few interesting kind of comments to provide some context for this presentation. First of all, it's Q3, so we've seen the big rebound from Q2 kind of behind us, and we're now seeing companies begin to trade on fundamentals. So some of the key takeaways on page 3 there. We are seeing those divergences come through on a sector basis, based on how well the companies are rebounding from the COVID crisis. We're also seeing regional divergences, and in very general terms, Asian business conditions continue to improve. Europe is now declining, and the US is kind of flatlining. So we've seen that sharp recovery, and now we're starting to see the divergence based on what's going on more in the real economy. So that's quite important to understand. From an infrastructure perspective, the increased mobility is helping. We're obviously, as we're in Q4 now, we're starting to see some lockdowns come through, some regional moving towards some national most likely, and that really is starting to impact the mobility again, and we're seeing the infrastructure stocks move around on that. The road and the rail stocks are kind of best positioned. The airports are still, the outlook for the airports is still very opaque. And so those stocks are down pretty heavily on a year-to-date basis, and probably will stay down for some time until we start to understand what a real opening up and a resumption of travel starts to look like. The exact opposite, the utilities, where broadly their revenues haven't been impacted by COVID. They do have a few bad debts coming through here and there. They get made up through regulation over the medium term. Those that have any sensitivity to short-term GDP or usage also get made up through the regulation over the medium term. So those companies are in pretty good shape. And mostly have recovered share price falls from Q1 and into Q2. The highlight I would make is that anything associated with renewable energy, there's a massive push towards ESG, and we are seeing a lower cost of capital and therefore higher trading multiples put against those businesses. So with those comments as kind of context, let's romp through a few pages. Page 4, just a simple traffic light valuation metric. Frankly, nothing looks expensive. We are seeing some fair value across much of the globe based on the rebound that's occurred. We are running some pretty conservative numbers through our models. The other thing that we have not done is adjust any cost of capital since pre-COVID. So we believe that over the longer term, we are going to see those bond yields come back up, and the longer term cost of capital, in our view, should still hold. It is a little conservative. It probably comes down a bit, certainly over the next few years. But from our perspective, we'll hold that in place, and we're still finding lots of opportunities across the universe. Slide 5 is really interesting. So, this is the box and whisker diagram that shows the adjustments to consensus earnings. So this is market consensus we're looking at here. Pretty importantly, airports on the left-hand side there, significant drop in earnings and a significant range. If you look from the end of the two whiskers, sort of min to max drop in earnings forecasts this year and next year. Out on the right-hand side, renewables and utilities looking pretty good. Not much impact to their earnings. And in the centre, communications, actually have gone up, and that's a part of partly a recognition of the amount of capital that is being deployed to increase the bandwidth on networks, continued rollout of 5G and so on. Really hasn't impacted those stocks at all. Let's touch on slide 9, the enterprise value to EBITDA by sector and by region. Now here we are seeing some red come through, but really this is areas where we've seen earnings impacted in the near term, i.e. this year, next year, based on COVID outcomes, and therefore they are trading at elevated multiples. And so, some of this earnings-related multiple data is actually giving pretty poor signals at the moment. So we'll move on from there to slide 12. And right there is your V-shaped recovery. So you can see, big dip in March with the sell-off, a very strong recovery. Now this is enterprise value to EBITDA again, so this does have some earnings anomalies in it, which has exacerbated the bounce back. But you have largely seen a recovery of those multiples pretty much across the sector. When you delve into a bit more detail, slide 15, on the utility side, first of all, listen, we've generally got these names trading at lower multiples than they were. Certainly on the gas side, which includes some of the pipeline names, they sold off and they've stayed lower. They've had some recovery, but not much, and a lot of that's the midstream pipeline space out of the US. The electric companies, are still cheaper than they've been for some time, and there's really good value in a number of these names. Very safe, strong dividends, good rate-based growth, great allowed returns coming through from regulators, solid parts of our portfolios. Renewables, I mentioned at the outset, we've seen a real trend towards those. They're playing on a lower cost of capital at the moment, so the multiples are higher, and you can see that come through in this data. The other area that's recovered well is water, as you would expect, very defensive. Let's touch on slide 16, which is the infrastructure side, and what stands out immediately is what's happened in the airport space, and this is a driver of a lot of the anomalies in the data, because the earnings over the next couple of years are well down. And obviously that has valuation impacts. It's not fully reflected in share prices. This is kind of nonsense data that's coming through. We see a similar impact in the rail sector. So analysts expecting volumes to be down, but we are still expecting pricing increases to come through. And so 2021 is looking a bit ugly from an earnings perspective. But 2022, we expect a pretty strong recovery in those names. Airports, you're talking more like 2023, potentially into 2024. And that's not taking account of the potential loss of business travel, for example. We're seeing anecdotally people starting to reduce business travel estimates by up to 30%. Over the longer term. So there are certainly some challenges in that space, but otherwise, toll roads, communications, energy infrastructure is looking cheap. That's a lot of the pipeline companies. So you can see a real divergence across the sector. It does require some active management. We're being very careful about that. We're seeing great opportunities for the portfolios, and we've seen a great recovery post the fall in Q1. So let me wrap it up there. Please, if you've got any questions, come back through your salespeople. It's Nick Langley, Senior Portfolio Manager, looking at the valuation pack for Q3. Thanks very much.